the term structure of interest rates becomes explainable for several different theories, and they all kind of merge together into what is actually happening. So here's a couple different ways to look at it. The first one is the expectations hypothesis, which is essentially saying that the long-term rate is a function of today's short-term rate and the expected future short-term rates. So the Federal Reserve has a great deal to do with today's short-term rate and almost always sets the short-term rate in everyone's mind. So the Federal Reserve's short-term rate and then the expected future Federal Reserve rates will impact the term structure of the interest rates. So if today's interest rate is really, really, really low, but we think the Fed's going to raise this over time, that will impact the yield curve as they expect in the future it will go higher. Therefore, they will invest their bond dollars accordingly. So the expectations of what will happen in the future, today's rate as a benchmark, and then what will happen to short-term interest rates in the future would be the expectations hypotheses. Liquidity preference is we certainly know that bonds, longer term bonds, are more risky. Therefore, generally, the return exceeds the expected return over time. So what we would like to think of is that the excess of the bonds in the long term over the short term is called the liquidity premium. So the long term bonds, function of N, over the expected return in the short term is liquidity premium. So I tie my money up for 30 years. I want more return than if I tie my money up for 30 days. So that's a big difference between the two, and that explains a lot of the normal yield curve. The yield curve has an upward bias built into it because of long-term rates, because of this liquidity premium. If you want to tie my money up for 30 years, you're going to have to pay me more for it. The yield curve reflects the expectations of future interest rates. We've all talked about that. We've also talked about the impact of inflation. It reflects the expectations of future inflation as well. The forecast of future rates are clouded by other factors, liquidity premium, etc., and an upward curve could indicate rates are expected to rise and/or investors require large liquidity premiums to hold longer-term bonds. And as we've talked before, and I've mentioned many times, that if you look at the yield curve, it's a pretty good predictor of the business cycle because the bond market is full of professionals. They are watching the business cycle very closely to see what is going on in the markets and in the economy in general. So longer-term rates tend to rise in anticipation of economic expansion. And the reason the rates rise is because people are selling their bonds and they're buying stocks and other risky assets because they think the economy is going to get better. And so if interest rates are falling and lower term rates are falling, that is anticipation of an economic, the opposite of expansion or deceleration in the economy. The economy is falling. An inverted yield curve may interest that interest rates are going to fall or signal a recession. We always look for inverted yield curves. If you see an inverted yield curve, that is a big yellow flag. Be very cautious. You want to get your LinkedIn profile up and running because you may be looking for a job, or lots of people may be looking for jobs as recession might be, not always, but might be on the horizon. As you can see, the term spread, the yields in the 10-year versus the 90-day Treasury. Over time, we've got the 10-year Treasury, the 90-day bills, and then the difference. You can see this starts at 1970 and works all the way to 2014. And you can see that they follow each other pretty closely over time. But they don't exactly follow each other. And then, of course, the yield spread, or the difference, spikes at different times in our past. You can see all of the movement in 1980, 1982. This was huge changes, and as you can see in interest rates, 12-14%. It was quite a bit, and then over time it's fallen quite a bit down, and the 90-day T-bills have been bouncing a little bit more than the downward cycle of the 10-year. So this is a version or a view of the yield spreads over the 10 and 90-year yield curves. And so we looked at them over here for 44 years. Is that right? 30, 44 years. Yeah, that's exactly right. And so the term structure of interest rates is a great indicator for you for looking at the business cycle. It also tells you quite a bit about the expectations of the marketplace and what's going on in future interest rates. And also liquidity preference, that you know that people would prefer to have short-term money. Holding all things equal, you'd rather have the ability to get your money back and have it liquid than have it not liquid. And so those are different preferences for interpreting yield curves. It's certainly a big part of the overall economy, and something that we would want to pay attention to closely as we move through our careers.